Hi friends, recently Indian stock market have started to give breakout. As you can see on my screen, Nifty in the last 5 trading session has moved positively up, and more importantly, Nifty has come out of this descending channel that started back in September 2024. So clearly the market has started to rally, but the $1 billion question is that is this rally sustainable? Can this rally really continue and take Nifty maybe up to 25,000, 25,500 level is what we need to find out. Now for this, what I really want you to focus on the FI selling and buying data, and you will see as of 20th of March, FI's net selling in the month of March has been around 22,000 crore. But more importantly, 2 days of buying on 20th of March and 18th of March tells us that there is definitely a buying interest shown by FIs in the last couple of days that we have not seen in the last 5 to 6 months. And also to put this 22,000 crore number in perspective, if you look at the last 6 to 8 months of selling and buying, you will note that in January they sold 87,000 crore, brutal selling. In February 58,000 crores. But if you look at December, they did around 16,000 crores of net selling. That is very less compared to what they did in January and February. And as a result of this limited selling, back in December, Nifty actually gained around 6%. Now the $1 billion question is that the current gain that Nifty has done in the month of March, which is around 4 to 5% here, as you can see, is this sustainable, or is it going to become like what happened in the month of December, that there was a short-lived rally and after that market again started to fall? For this, what we really need to look at is the two macro factors that FIs continuously track. One of them is US dollar index, which is how strong US dollar as a currency is versus the global currencies. And what you will note here is the pattern is that in the last 3 months, US dollar has been weakening, right? And you can see it has come down from almost 110 to right now at 104. So definitely when US dollar weakens, what happens is that Indian market or emerging markets become more attractive for FIs. But if you look at the last 3 years, US dollar index bottomed out at around 100 or 101. You can see the data here. And in my view, if the US dollar index cools down a little bit more, if it comes down to let's say 102, 101, we can definitely see more buying by FIs, and definitely the net selling is going to be reduced. And the second key factor that typically FIs looks at is the US 10-year Treasury bond yield. And if you look at my screen, you will see that currently it is at 4.25%. Definitely it has come down massively from where it was in the beginning of this year at around 4.75%. But if you look at where we were in September 2024, it was at around 3.75%. This is the number that I think still needs to come down. Definitely if it comes down below 4 at around 4, then I think this rally becomes very sustainable, because the return that they're going to get from US 10-year Treasury bonds is going to be limited, and therefore it makes Indian stock market much more attractive for FIs, and we might be able to see sustained buying by FIs. So right now, in my view, it is wait and watch, and more importantly, what we need to do as an investor is not worry about the short-term noise. I've been continuously talking about these short-term noises on my channel, and you would have got a lot of good insights about that. But in this video, I want to speak about 5 stocks that are literally less impacted by the tariffs, because tariffs remain a constant uncertainty in the market. Because let's not forget that 2nd April is not far away. Trump is still on the path of implementing reciprocal tariffs for India. The impact of that, again, a separate topic altogether. But in my view, what we need to do is look at those stocks that are fundamentally strong, and secondly, more or less they are tariff proof. It means they are not going to have large impact because of tariffs if they come at all. So in this video, I'm going to run you through those 5 stocks that in my view are largely unaffected by the tariffs. They are fundamentally strong. These are not recommendations here. Throughout this video, I will teach you interesting investing concepts. For example, how to look at the PEG ratios and make important decisions based on some key parameters. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a content creator. With that, let's get this video started. The first stock that I want to discuss with you is Jio Finance. In my view, largely unaffected from the tariff threats, because the business is not into import and export. This is mainly about Indian consumers and how finance is going to play an important role in Indian consumers' life. So back in April 2024, the market was extremely bullish about this company, and at that time the stock had hit all-time high of 395 rupees per share. And there is an important learning for all of us here is that sentiments is what has been driving Jio Finance as a stock stock because if you see, nothing major has changed or deteriorated from fundamentals or valuations perspective, but the sentiments at that time were very, very bullish. Right now, the sentiments are not so bullish. It's very bearish. But what we really need to understand is how do we see this business 10 years from now? Because if you look at my screen, you will note that the businesses that they are building is phenomenal. For example, they are scaling up their NBFC business, which is the Jio Finance Limited. They're into leasing services. They are into insurance. And recently there was a news in the media that Jio is getting into an agreement with Alliance, which is breaking up with Bajaj. So very, very interesting maneuver happening here in the insurance world. But coming back to their group structure, they are into payment business. But more importantly, they are heavily getting into the wealth management sector, which in my view have a lot of room to grow. Because let's not forget that in India, we only have demat account penetrations at 12%, while in countries like US, you have something like 62%. So huge scope in wealth management sector, and that is what they're trying to scale from now on. And in such businesses, when they're scaling up, really, if you look at the fundamentals or their earnings, you won't find much. For example, if you look at these numbers here in terms of their P&L, you will see that last year, 9 months, FY24, they did 1294 crores of profit. Very, very muted growth in the profits because they are still building their business. So a natural question comes here, Rahul, what can we track about this company? So you can definitely track a lot of things about this company in terms of what sort of licenses are they getting, what sort of MOUs they are getting into, what sort of partnerships are they getting into. And also at operational level, you can look at some of the metrics. For example, how many monthly average active users they are able to bring onto their platform, Jio app. And right now, if you look at, for example, Q2, it was 6.5 million. And if you look at the Q3 data, it is at around 7.4 million. So definitely they're growing in terms of the number of users, because please understand, once a customer comes into Jio app, these guys can sell them multiple things. They can sell them loans, they can sell them loan against mutual funds, they can sell them insurance. That is why they're building a lot of diversified businesses within the Jio Finance as a group structure. Having said that, the biggest risk that this business in my view faces is the regulatory, because they're trying to build businesses which are catering to different regulatory bodies. For example, RBI is there from an NBFC perspective, from a payment perspective. If you look at the insurance sector, EDA is there. If you look at the wealth management, SEBI is out there, right? So dealing with so many compliances creates its own challenges, and this is the key risk in my view. They might see some setbacks throughout this journey for the next 8 years or 10 years, but this stock in my view remains largely unaffected because of the tariff news. Of course, if the market sentiments are down, this is also going to take a hit. But does that present opportunities for you? Something for you to take away, think about it and decide for yourself. Please do not take this as a recommendation. I've genuinely shared some data points and some insights that may be helpful for you. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. With that, let's move to stock number 2, which is Mahindra and Mahindra. If you've been a regular viewer of my channel in the last 2 years, I've spoken about Mahindra and Mahindra a lot because this is a truly turnaround story in Indian auto sector in my view. Have a look at my screen. You will see that since COVID, how the return on equity this company has been able to deliver. It's been consistently growing. If you look at the earning per share here, still growing at a very, very healthy rate. So in the last 4 to 5 years, the way Mahindra and Mahindra has transformed itself in terms of the earning per share has been a phenomenal topic of discussion. And this comes from the fact that it is gaining market share and leadership in the SUV segment. Have a look at my screen. You will see it is number 1 in the revenue when it comes to the market share, and it is now constantly going up. It's now at 23%. If you look at the volume data also, it is at number 2. But because it is delivering more profitability as compared to its peers, it has done wonderfully well when it comes to the revenue market share. If you see their farm business, again, we will find that there has been a constant increase in the market share. It has gone up to 43.9%. When it comes to their commercial business, 3 segment, I'm not showing the picture here. They are not doing pretty well in one of the segments. But again, this is very operational and these things will move here and there. What really matters is the long-term story for Mahindra and Mahindra. And one of the biggest risks recently the company has faced is Tesla's entry into Indian auto market. A lot of people believe that when Tesla enters into Indian stock market, it is going to kill a lot of auto companies within India, but also we need to look at this from a pricing point of view. So for example, if you see my screen, what this note tells us is that the cheapest model that Tesla sells in US is around $35,000. In India, the average selling price is at around $14,000. So it is very, very low. Even if Tesla were to launch, let's say, Indian version of their model, maybe at, let's say, $25,000, it is still going to be out of the reach for many Indians. So there is a play here in terms of the pricing. Therefore, a lot of experts are downplaying the entry of Tesla into Indian stock market as a threat to stocks like Mahindra and Mahindra. Then comes the duties and the impact of tariffs. So we have 110% tariff on import into the Indian auto sector, and recently Indian government has announced that it can be brought down to 15%, but there are a lot of T's and C's that the companies will have to follow. For example, they will have to invest up to 500 million of money into India to set up some plants and things like that. So there definitely are some T's and C's. And yes, there is going to be a minimum impact from a tariffs and duties perspective if Indian government changes its stance. But in my view, it is a short-lived fear, and the duties and tariffs may have some minimum impact on these sort of stocks. But if you look at the long-term view, Indian auto companies have the edge in terms of the pricing. Last point about Mahindra and Mahindra is that recently I did a detailed post on my YouTube community talking about the rights issue that Mahindra and Mahindra as a group is coming up in two of their subsidiaries, and how Mahindra and Mahindra as a group is actually going to buy those rights issue if they go unsold. Again, a detailed commentary I wrote on my YouTube community. These are the updates that you really need to be aware of if you're investing in any stocks, because they bring you a lot of insights that may help you make some good investing decisions. So if you're not yet a member of my YouTube community, you can consider joining my YouTube community. The feedback of the community has been excellent. Simply go to my channel, press on join button and be my guest. With that, let's move to stock number 3 now. Stock number 3 is from consumption space, a company called Trent. The moment I think about Trent, what comes in my mind is very, very high PE. For example, in the last 5 years, if you see, the median PE of this company has been around 178. So what is it that the company trades at a very, very high PE? Mainly because of the growth. For example, have a look at my screen. You will see that in the last 3 years, if you see, the profit after tax has gone from almost 35 crores to now 1935 crores. You can do the maths. I'm not very good in maths, but you see the phenomenal growth in the profit after tax the company has delivered in the last 3 months. And because of this growth, the stocks start to trade at a very, very high P because the fundamentals have been very, very strong. Now, what has been driving this growth in Trent is that if you, for example, have a look at the Zudio's expansion program that the company has followed in the last 3 to 4 years, they have been opening stores at a CAGR of around 61%. This is a huge growth and expansion in the number of stores they are opening for Zudio. If you look at, for example, West Side, not such a high growth in store count, but it is still gone up from 168 to 238 in the last 4 years. So definitely some growth in opening the new stores, and this is where Trent's growth is coming from. Can this sustain or not is a separate question, but what we have seen in budget 2025 is that income tax have been relaxed. So in my view, that is definitely going to help with the consumption. The demand should pick up for retail companies, and therefore if Trent continues to open the stores like this, they're going to continue to enjoy the growth in their profitability. Now, in the recent quarter, if you see, the FIs have done some selling in this particular stock. The stake have come down from 26% to almost 21%, but the DIs have done some buying, gone up from 13% to 15%. One of the other risks that people have talked about for Trent is the entry of Shein with Reliance in the retail space. Definitely, this has caused some sentimental negative impact on Trent as a company. But overall, to be honest, competition is likely to be there anyway. But it really depends on what sort of demand we see from Indian consumers in the coming quarters. But hopefully this insight helps you understand a bit more about this company Trent. With that, let's move to stock number 4 now. The fourth company that I want to discuss with you is from the banking sector. Have a look at my screen and you will see the reason I am talking about banking sector right now is that if you listen to any expert, you will get to hear that the valuations in banking sector is very, very attractive right now. Have a look at this pink line here. You will note that the PB ratio of the banking sector as a whole is running all-time low right now. It's gone back to almost COVID level. It is somewhere here below 2.4 here. It used to be at that level back during the COVID time frame. So from a valuation perspective, banking sector, especially the private banks, people are saying that they are highly undervalued, and that's what even the PB ratio is showing us. And secondly, very, very recently, RBI has been really going very, very easy on the liquidity. There has been a lot of release of liquidity in the last few weeks, and therefore that is also in long term going to help banking stocks. Now, for a moment, if you concentrate on private banking stocks, have a look at my screen, you will see the top 4 private banks. HDFC, ICICI, Kotak and Axis Bank. You will quickly note that if you look at the PEG ratio, which is price divided by the earnings growth, very, very important concept I really want you to understand here. You will note that ICICI Bank and Axis Bank are showing the lowest PEG ratio. Lower PEG ratio means better for investors. Why it is so? Because if the price is low, that means you are paying less price for higher earnings per share growth, right? That's the whole idea. But now if you see ICICI Bank and Axis Bank, they are almost very similar PEG ratio, and the question comes, which is a better investing bet here? Now I cannot tell you which is better here, but what we need to understand is what is happening in Axis Bank and ICICI Bank. So in Axis Bank, if you see, the price is low and the earning per share growth is also low. So the net impact is that the PEG is low. In contrast, if you look at ICICI Bank, what you will notice is that the price is high, but the earning per share growth is also high, making the overall PEG ratio lower. Now it really depends on what type of investor you are. So if you are that type of investor who says that, you know what, I'm going to invest in Axis Bank because the price is low, and I believe that the earning per share growth is likely to grow in the next coming quarters, therefore I am better off buying at low price. So you have your thesis here. While the investor B might say that, you know what, I don't want to stick with a company that has shown very poor EPS growth in the past. I can't be really certain whether the company's EPS growth will grow or not. They will look at stocks like ICICI. They will say that the past track of the company is that the company has shown very, very high EPS growth. Therefore, they are okay to pay higher price and they're likely to buy that on dips. This is the whole concept of PEG ratio. And the reason I've explained this you with practical 2 examples here is that I really want you to focus on PEG ratio in addition to looking at the PE ratio, the PB ratio and many other metrics. This will definitely help you make better investing decision when you're picking from 2 or 3 stocks. And overall, if you see my dashboard, you will see here clearly in the last quarter, ICICI Bank has delivered the maximum growth, followed by Kotak, followed by Axis Bank, and then HDFC Bank has given very, very muted result when it comes to the quarterly growth. But if you look at the long-term picture, very, very quickly, you will see that ICICI Bank here has delivered 35% profit growth in terms of CAGR in the last 5 years versus HDFC Bank and Kotak, which have gone at around 18% or 16% respectively. So hopefully you find this data point also interesting for you to do some more research on the banking stocks. The last company that I want to speak about is REC Limited. This company is largely unaffected because of tariffs. But more importantly, if you see the last 4 years of P&L track record, you will see that the top line has grown by around 11% CAGR, not a huge growth, but decent growth. But if you look at the profit after tax, it is grown by around 17% of CAGR. If you look at the shareholding pattern of this company, very interesting one, that in the last 2 quarters, FIIs have remained solidly invested in this company. The stake have been higher than 20%, while the DIs have done some profit booking. 14.25% have come down to around 13.91%. But what really matters for this company is how the loan book of this company is growing. For that, have a look at my screen. You will see that as of December 2024, the company has an outstanding loan book of 5,65,000 crore. Now, what the company's management is saying is that they are projecting or they are aiming to double this loan book to 10 lakh crore by 2030. That's a very, very bold target. And whether it is possible or not, only time will tell. But there are few things that the company has been doing right recently. For example, they have signed MOUs worth 1.12 lakh crore with the renewable energy developers. This happened back in September 2024 because they want to take the renewable energy loan book to almost 3 lakh crore by 2030. And I think the recent development of they signing MOUs tells us that definitely they are on the right track. Whether they will achieve this 3 lakh crore number or not is yet to be seen, but definitely there is some movement here in terms of their MOUs. So in my view, companies like these need a lot of patience, and you have to really think through whether the company is likely to grow in the long term or not. But the recent correction, if you look at the PE ratio, it has come down to almost between 6 to 7, depending on when you're watching this video. Median PE has been around 6.1. So definitely the valuations have come down. Ultimately, it depends on what sort of growth they can deliver in the future. But definitely the company is looking very, very aggressive in terms of growing their loan book. With that, I've talked about 5 stocks in this video. Please don't take them as recommendations, but hopefully you've got a lot of insights about these 5 companies. And also have got a good insight about where the FIs buying, selling right now stands and what are the factors that really impact FI selling and buying in future as well. Hope you enjoyed this video. If you did, press the like button. Let me know in the comments a simple thank you. You can also consider joining my YouTube community if you want to really learn investing in a practical way. If you want to get daily insights that will help you make some good investing decisions. With that, I hope to see you in my next video. Until then, keep rocking.